Should I contribute to my Roth or traditional 401k? This is a question that gets vitally important the closer you get to retirement. And the way a lot of people answer that question is by asking, where do I think tax rates are going to go? Are they going to go up or are they going to go down? When I used to ask this question in front of a room full of people, the answers I would get were usually a lot of laughs and, of course, the assumption that tax rates are going to go up. But the truth is, this question is a lie. There's a much more important question that you need to ask yourself, and we're going to explore that today. So determining whether you should contribute to your Roth 401k or your traditional 401k really comes down to two main questions. And the first one is, what is your current marginal tax rate? So if you put money into a traditional 401k, your marginal tax rate is the amount of taxes that you'll be saving this year. So for instance, if you are in the 24% marginal tax bracket and you put $10,000 into your traditional 401k, you're going to save $2,400 in taxes this year at the federal level. But that's not the end of the calculus, because now we have to ask, what is your projected future tax rate? Not what are tax rates going to do in general. We have no idea. It is what is your projected future tax rate. Now, the further you are from needing this money, the further you are from retirement or financial independence, the harder it is to answer this question. But as you start to get closer and closer, it becomes a little bit more clear. Now, you might be saying, Scott, I feel really strongly that tax rates are going to go up. I'm going to push back on you a little bit. I used to think that too. In fact, I was positive of that. I was so positive that tax rates were going to go up. I mean, how could it not, right? Debt was continuing to go up in the U.S. We were approaching the debt ceiling, and it was really scary. Markets seemed to be in turmoil as I was reading the news, and I was just positive. Tax rates have to go up, so I put all my money into Roth, and I wasn't a financial planner at the time, because this was all the way back in 2013, 14, 15, and I was just positive that tax rates were going to go up. And guess what? Tax rates went down. So you just never know. Now, do I agree that probably the trajectory that we're on, I think tax rates have to go up, but I don't know where they're going to go up. What if they go up on corporations only? What if they only go up on billionaires or only go up on the top tax bracket? Maybe they keep the more middle class tax rates similar, or even give a tax break to the more middle class tax bracket. So that's why I say I used to think I knew what was going to happen with tax rates. The truth is, I have no idea, and to be honest, neither do you. So you need to do your best to figure out what your tax situation looks like, because you have a little bit more inside knowledge on what's going to happen there. Okay, Scott, that all sounds good, but how am I supposed to project what my future tax rate is going to be? This one is a little bit more difficult, I'll give you that. But one bonus question that I'm going to give you is, what are your expenses? Because if you assume that your ongoing annual expenses are going to be similar throughout your life, not going to be exact, of course, but similar, you don't expect them to double in retirement or even go up by 50% or decrease by 50%. By the way, it's very uncommon for that to happen. Usually your expenses steadily increase a bit, but mostly stay in a similar range. If you have a really good idea of what your expenses are going to be, we can pretty much, for the vast majority of you, assume that your after-tax income in retirement is going to match your ongoing annual expenses, right? Because you're pulling the amount that you need out of your portfolio to fund your lifestyle. You're probably going to have a shortfall that you need investments to cover, and you're going to pull enough out to match those expenses. That's going to give you a decent idea of where your income tax rate might be in retirement. All right, so I want to show you an example of what this might look like, and it might be a bit of an extreme example just to illustrate the point, but it's pretty realistic for someone looking to reach financial independence early. So this couple they are 45, and they, right now, while they're working, they're in the 32% marginal federal income tax bracket. So you can see that from 45, 46, 47, they're at 32%, and then the tax laws revert back to what they were, and they bump up to 33%. Now, when they retire, all of a sudden, they lose all of that wage income. Obviously, they're high earners. They lose that wage income, and they're using investments to live off of. So their expenses are obviously much lower than their income during these years, because they're able to drop all the way down to a federal tax rate of 10%. So what would it take for this to actually be doable? It would take them having a lot of Roth IRAs or taxable brokerage accounts that they can pull money out of, or just cash savings account that they can live on, which is something that I see quite a bit. Now, once again, this is probably a very extreme example to be showing you, and this gap here, this big gap where we're down here in the 10 and 15% tax rate, that's where we have opportunities. That's where tax strategies like Roth conversions, capital gain harvesting, all of those things can happen during these years, because way out here looming in the future with traditional pre-tax 401ks and IRAs are required minimum distributions. And you can see that when those kick in at age 75, they would bump up to the 28% tax rate. So one strategy for this couple might be put the money in while they're working, the traditional side of things, the traditional 401k, then smooth out their income from 55 to 75 by doing Roth conversions, by pulling money out of their traditional accounts when they could maybe pull money from other accounts. So those are the types of strategies that you need to look at. But this illustrates exactly why, even if tax rates go up 20% from where they're currently at, if they're in the 15% tax rate from age 60 to 75, then a 20% increase on that is only taking them up about to 18%, which is still much lower than 33%. Now, in a future video, I'm going to talk about the difference between marginal and effective tax rate. I'm not going to get into those details right now, but that's where I think it'll really pound home the point that if you're a high earner and you're a few years from retirement, if your tax rate, your tax bracket is going to drop, it probably makes sense for you to take a hard look at prioritizing traditional contributions. So of course you may be saying, well, my tax rate is probably going to be the same. Maybe you're in the 22% bracket right now, and you might be saying, well, I think that tax rates are going to go up because in 2026 they revert back to what they were. And that very well may be the case for you. And I would agree that since that's what we know that tax rates are going to go from 22 to 25% in that specific tax bracket in just a few years, it probably would make sense for you to think about that as you make your Roth versus traditional contributions. But if you think your overall income situation will change from one bracket to another, the more important question is, what tax rate are you paying today versus what will your tax rate be in retirement? Now, in a future video, I'm going to talk about the difference between a marginal tax rate and an effective tax rate, because in retirement, that effective tax rate is going to be vitally important. And later this month, we're going to look at some examples of how you can do the math to determine what's your break-even point. How much would tax rates have to go up for this to matter in my situation? So look forward to that, and until then, have a great rest of your day.